Hi, this is Randy Finney with the right side of the chart, and this is an early session update for Tuesday, September 23rd, 2025. It is 10:02 a.m. Eastern Time, so I'm starting the video. I figured I'd get one out early. I was going to do one yesterday and just kind of looking, just watching everything, just not feeling it, and not really having a lot to update. I've had a couple price alerts go off in the last sorry, I had to pause it there for a real quick, take a phone call. So since yesterday here, I'll show you. I have an alert log here. So I'm going to go over this. I'm going to start the video out. Oh, let me tell you how I'm going to do this. You can skip ahead. I'm going to start out, as I often do, with a quick update on the equity markets. Here's the alert log. I can't zoom this in, but you can see yesterday I had Meta and Amazon breaking down, and they broke down right after the NVIDIA G. Sorry, one more phone call. All right. Anyways, I'm back. So I had yesterday those two fired off shortly after the NVIDIA Chat GPT, OpenAI circle friggin' jerk thing going on. You know, they give, okay, we're going to give you $1 billion, but you're going to put $1 billion into, it's just moving money back and forth between those two. The big deal they announced. Now, again, so what that matters, yeah, it sounds, they walked them out, paraded them out on TV. Why they did such a big dog and pony show to promote it. Their stocks are doing great. You don't think they need to, but whatever, it doesn't matter. What matters is these guys went down. And again, I try not to make too much any one day because one day doesn't make a trend. But Meta and Amazon broke down from pretty well-defined bearish rising wedge patterns. With Meta, maybe they're what we're seeing now was a really narrow breath yesterday. It was really when we went down from the Mag 10 holding the market up yesterday was the Mag 2. It was just Apple and NVIDIA were the only two. Most of the other former Mag 10 or whatever stocks were kind of sucking wind a little bit. But again, I always say one day doesn't make a trend. I just want to point out they broke down. So here's my price alerts for the last 2 days. The Ruger I got out to you today. Not much else to add. I'll hit on it for those in it. Remember, it's kind of a paired trade with the SWBI, Smith and Wesson. Oh, look at that. We're taking out T2. We'll see if it holds. This is a pretty significant resistance level. But whether this breaks out and runs is going to depend on the Smith and Wesson trade. Now, the thing about Smith and Wesson, that was the first one I gave you. I followed up with Ruger right here a few days after, coming off that nice divergent low. So again, depending where you took it there, you're up 20, well, I said 21, about 22, 23%. Or you took it on the breakout above R1 here, the downtrend line, or R2, then that gives you about a 17% gain. And now it's still going up there. So if it can hold and breaks out, that's T3. Now I'm assuming, I haven't even checked it yet, but I checked it earlier today at the time. Yeah, Smith & Wesson's still holding down below that downtrend line. And it's beautiful resistance. And again, it's a level I think will go sooner than later. And if and when it does, and maybe Ruger will carry it up if Ruger breakout holds. Now, again, the day is young. If this break down the market, I'm going to get to the equity markets, back to those in just a second. Then you'll probably see profit taken on the Ruger trade. But like with any trade, if you like it, pick your target. You have a trading plan, and if you're targeting these higher targets, just keep raising your stops. Let's get in. This one we went long right here, first highlighted, and that one again. That one's already hit that second downtrend, beautiful intersecting resistance right there. Triple resistance, downtrend line, 200-day and price, and it's been consolidating. So again, kind of a paired trade situation. Paired in the same direction, not like the what was that, the last paired trade I gave you, Novo and Lilly, paired in the opposite direction if you wanted to do that. Okay, so real quick, back to the markets. This is pretty simple. This is the wedge I gave you before the Fed. As expected, we had that post FOMC volatility highlighted. We broke down pre-Fed. I put a line here to show you when the Fed announcement was. And so as expected, you get that volatility. And as expected, I often say the initial reaction is often not the reaction that sticks. Initial reaction, they sold it off on the quarter point rate cut right back to that, which is a really nice support level / potential target. And then we went up and we've been back testing. That's it. 1, 2, 3 back tests. As I say, the problem with shorting back tests, I'll highlight them as objective entries. That's what they are. But what you really want to see is an impulsive rejection. Yeah, one there a little bit, but it didn't stick. We have another fairly impulsive rejection at the open today. Let's see how the day pans out. But right now, if you take it on face value, it's a breakdown, and one of these breakdowns will ultimately stick. I know there's a resilient bid in the market, and I will say that I've seen these type of markets before. They're very unusual, but we're clean breakdowns. Usually you break down and that's it, one and done. You get a sell signal, and I'll highlight them as they come. This was really not a sell signal, just a divergent high. But this one, you had a sell signal and then boom, back test, boom, back test, boom, back test. So it's been just a resilient, very resilient trend. But that's the technicals. I don't know any other way to spin it. It's a breakdown so far, a back test. We had a divergent high at this point, as I highlighted pre-Fed. We broke down again. I say take any breakdown pre-Fed with a grain of salt because whipsaws are more than common. But if you look at it for what it is, it's just a breakdown, a back test right now. And then we're starting to, let's see if we can build on it. As I like to say, the redder the better. You want to see a solid 60-minute candle close below there. By 60-minute candle, I'm talking ideally now on QQQ. That's the main one most traders are going to watch during the regular session. And the first candle on a 60-minute chart every day is going to only be a 30-minute or represent 30 minutes of price action. That's because there's 6.5 hours in the trading day. So your 10 a.m. candle only has 30 minutes of trading in there. But as of now, you have a breakdown right there, and you're working on the next candle because we just rolled in. It's 10:10 now, so you're working on that second candle. So if we can get a close below there, it's a start. It's a sell signal right now. It's a breakdown as it is. If it can print another red candle there, then all the better, and that's it. So breakdown, sell signal, back test, and that was a divergent high. Then this is just extending the divergence. That's it. Sorry, not much else to add to that. Let's look at ES, the S&P 500. Let me grab the ES futures. Where are you guys? All right, here's my ES. ES, same thing. This is the 60-minute trend line right here that triggered a sell signal breakdown pre-Fed. And that little spike down there, this is the post-FOMC noise right there, a little initial knee-jerk reaction. Back test, second back test, and just like QQQ, and this one's holding up a little bit better, you need to break this minor uptrend line. It's not as well defined. On QQQ, I had it 3 reaction points, but we're hovering right on it or right above it. So again, you need to see that break, and then if we get a half decent correction, should bring us at least to this level. You can see all the marked levels are all potential targets. This is that big level comparable to that T2 I gave you on the last QQQ trade. Remember, we had a QQQ trade that was short entered here. We hit our first target quickly for, I forget what it was now, 2.5%, 3%, whatever, a small gain. It was a short-term trade. Then went on to take out the suggested stop for if you didn't cover, if you held on for any of these targets without taking profits at T1, you had a stop that was, I believe, equal or a little less than what we made on that first target. But this is the big level. I'm leaving that on there for now. Because that's the level that I still think will be a very significant level if and when taken out in the broad market. So just looking at the 60-minute chart of QQQ, I know this chart's a little busy, but this is that primary uptrend line. That was the pre-Fed sell signal, the FOMC whipsaw right there, the initial knee-jerk reaction, back test, and there's the little break of the trend line that I just showed you a second ago. And here's what it looks like on SPY, the S&P 500 tracking ETF. I'm going to tighten that line up. We can hold it right there. That's probably the best fit because that has 1, 2. We had a candle there, a little brief violation, but you have more reactions there. Either way, you kind of get the gist of it. We need to do this and get down here today to solidify this sell signal of the break of the minor trend line. Okay, back to the two that I had fire off yesterday, sell signals. Again, they weren't very deep below there, those trend lines, but I'm going to show it to you what I've had here. This is when it fired. You can see that fired off at Amazon was right at the open yesterday, right after 9:30, shortly after. So we broke down, and was this nice clean up trend line on the 60-minute chart. Follows this, divergent high, ever so slightly marginal new high was a divergent high as well, sell signal, and that's where we're at. So it puts this one on a sell signal on that 60-minute chart, as well as a daily. You can see the trend line there. It's nice and clean as well. But you're still, like most of these big mag 8, 10, whatever you want to call them, stocks, still above the 200s, and that's a key level. We regained the 200s right here, actually, with a gap up. This is when we took out the 200s. So any pullback, you can see it's really nice price support comes in with the 200 days. That is a near-term target for Amazon if it breaks out. Now, bigger picture, I think there's a good chance it will. Despite, I know right now, and I've been reading, and I had the TV on yesterday to see when I saw the movement in the video. I wanted to see what the news was, and of course I told you they had the dog and pony show there with their CEOs out there. But you can't find right now, it's like finding a needle in a haystack to find an analyst that's bearish, and most are now starting to call. I've seen more and more calls for a la 1999 style blow off top, or even 1929 style blow off top, followed by a big crash. So it seems most of the analysts that are bearish now, even those that are perma bearish, are now leaning towards a blow off type scenario. And hey, anything's possible, guys. Anything's possible. But when you get too many people aligned with the same thing, be careful. Be careful with that when you get a crowded trade like that. All right, so Amazon, again, I just wanted to point out there's, you could probably even go like this. Yeah, that sub wedge, just like I gave you on QQQ. This is your primary trend line off the January 2023 lows. And it was broken here, back tested, and now we just broke that minor trend line, the wedge. But you still have the 200s that need to give way. And if any of these big, you want to watch these because these are the big market leaders, whether, they've been leapfrogging each other in the past few years between Microsoft, Apple. Those two kept leapfrogging each other for the biggest title of the largest publicly traded company. Then NVIDIA took over, and we'll see. Again, it's been just a back and forth thing. But they all have a significant mathematical weighting on the markets as well as psychological. So I just wanted to give you the two that I had breaking down yesterday. The other one was Meta, and Meta had this uptrend line off the April lows right there, breakdown there. But it doesn't look too bad. You have a lot of trades up here, and this would be really these two levels right here. Those are your next levels that would indicate we're probably going down a lot more. There's a lot, if you look at my volume price histogram bars, a lot of trades occurred up here. So yes, we broke down. Yes, there could be more downside. The stock's hardly down today, so I don't even want to spend too much time on it. But again, when you look at the charts, it's been building these big divergences for a long time. You see it best on the weekly charts on a lot of these stocks because these divergences have been building so long. And as I talked about, a lot of the mag, whatever you want to call it, 7, 8, 9, 10 stocks, they're poised to make these bearish PPO crossovers on the weekly chart. That's what I'm on right now. Once you make that, these red, what I call inverted hills, tend to define the periods, even in a larger bull trend. They're the corrections in the larger bull trend. They're also the bear markets when these stocks drop well into the double digits right there. So green is a bullish trend. Red is correction. Corrections can, I always say, happen in one of two ways. You can move sideways when you're going, whether you're going down or you're going up. That's a correction as well. Prices go, of course, there was some downs in each of these, and some bigger than others. That was a double-digit drop all day long right there. And so I just want to point that out. And when I rifled through them, NVIDIA just made its first, look at that, we're this week. Now, I'm going to say this and I'm going to repeat it. The week isn't over yet. Today's only Tuesday. The week is very young, in fact. It's early Tuesday. So all that matters is how this closes on Friday. But right now, I don't know if you can see it there. I'll tell you it's red first, meaning the PPO is crossed, even despite yesterday's rally in NVIDIA. And it's negative at this point in time. I don't have the measurements up, but I'll try to do it for you right now. There was our previous crossover, and again, you had a little whipsaw where it went green in between there, and you can see this is what we also crossed down here. So you had this multi-month period. This was almost a year of sideways price action. And so there was a correction in Nvidia, which nobody's going to argue that stock's not in a bull market. And so there's a correction in a bull market, mostly sideways, but a lot of double-digit drops within there, and especially triggered when you got the bearish PPO crossover. Those from the high to the bottom in the range. What I'm going is from right here at this point. I have to here. If you do it this way, if I turn off all my annotations, I can grab the high and then go down to low. And to give you an idea, that was a 43% drop. Very few investors, even definitely no swing traders, but very few investors want to ride out a 43% drop. So again, that was telegraphed by these bearish PPO crossovers. There was another one there. So I'm just going to rifle through and kind of show you the state of the union, if you will, on these mag stocks. So there's Microsoft, and again, I really like to see these best use these PPO crossovers on the weekly when after there's been a nice clear trend, whether it's a bearish trend and you're on a red hill and I'm looking for that green crossover, or a big green hill like this. These work much better. In fact, I stay away from them in a sideways market because you're going to get whipsaws. So y'all like to see the what I call big green hills, and then get the crossover there. And from that point there, it's probably easily a double-digit drop in Microsoft. I just want to point out that one just a few weeks back fired that sell signal. It's also broke down below the trend line right there. This white, there's your uptrend line. This is just my path on where this stock's headed in the coming years on the weekly chart down there. That hasn't changed. Apple, best of the breed right now. Best in show, if you will. As far as, catching up, playing a game of catch up to its the rest of the lot, and Alphabet as well. Those two. Alphabet's way above the trend line. It's a lot of work for Alphabet to trigger a sell signal. But Amazon, you can see on the weekly here, within spitting distance. And as I often say, there are no guarantees, but you don't have to be an expert market technician to anticipate when you're going to get the bearish crossover. And guys, remember, this is the PPO histogram, which is using these two lines here, the PPO and its signal line there. And this is a momentum indicator. So it's showing you, despite the fact something's going up, that the momentum is slowing. And this is what we do, and this is what my style is largely part of. If you want to chase something, if you want to know why I haven't been buying NVIDIA for the past 5 years on every single pullback, it's because I trade NVIDIA. We've been long and short many times. I swing trade. I'll try to call these, get positioned for these turns. Sometimes we'll milk almost every penny of it. Quite often not. We'll get a good part of it, and that's it. And when the charts aren't clear, stand aside, move on to the next one. So I'm just trying to show you here. Last time we had a bearish PPO crossover. And by the way, guys, I don't just use any one thing alone, not in a vacuum. I like to use, again, when something's in an uptrend, you want to give it the benefit of the doubt and have a strong reason. There was Amazon right there, which we were short the market in Amazon, or at least a market. I don't know if Amazon would have covered it in a video at this time, but you had both the beautiful clean sell signal. That was a very well-defined, beautiful trend line, unmistakable red candle, like I like to say, the redder the better, and it coincided with that bearish PPO crossover. So there was every reason in the world, and followed a big divergent high in overbought conditions. So there's every reason in the world to be short Amazon. Once it broke down below that trend line, it dropped 31%. All right, what has it done now? Well, we come full circle. I mean, this is when we had our first trend line break there. That was a sell signal based on the trend line break. But what happened? Came in, came back to the 200-day moving averages. This is a secondary trend line right there. And this right now, again, I will repeat, the week is young. It's Tuesday. But as of right now, that's a sell signal. It's going to be finalized and official if we get a close on Friday at 4 p.m. and we're comfortably below that trend line. Otherwise, you could get a stick save. This candle could rip back up in here and park right here at 4 p.m. on Friday. And guess what? On the weekly, at least, that's not a sell signal. On the daily and the 60-minute chart I just gave you earlier, yes, we do have sell signals. So if they carry down and follow through, then we're going to get that weekly close there. And we may even get a crossover for the first time after this nice green hill right there on the Amazon. And again, the last time you had a comparable setup, boom, boom, the stock fell, whatever I just told you, 30-something%. All right, and what was the other one I gave you? Meta. I just gave you Meta. Oh, wait, I was going through the rest of the mag stocks. Well, we're going to get to Meta's next up anyways. So there's Meta. Okay, what do we see on Meta? All right, here's the trend line I had all the way back here. That was a nice, clean, a lot of reactions, uptrend line on the weekly chart, sell signal right there with a solid red candle through there. And what happened, we also flipped and got a bearish crossover on the PPO that week. From there, Meta dropped down about 25%. What do we have right now? Well, we have an uptrend line right there. We're still above it, and this is still green, this histogram. But remember, on the shorter term time frame, I just had a sell signal on Meta. So if that carries through this week, and these are things to watch, and we get Meta closes below where it is today, especially by a good amount, check your weekly chart. See if you got the red flip on the histogram if I don't cover that on Friday. All right, so Broadcom, one of the strong ones right now. No threat for a bearish PPO crossover, at least not right away. Doesn't look like. Tesla also doing well. So it's a mixed bag, and I'm seeing that. I'm seeing a very mixed bag in the markets. In fact, yesterday, I was looking, the majority of stocks were down in the broad market. The broad market's the S&P 500. This is the equal weighted, is going nowhere. But you're seeing the cap weighted S&P because of NVIDIA and that massive weighting it has now on the indexes. The S&P, has just made new highs yesterday, but not the equal weighted. The equal weighted right now is trading exactly where it was. So that just tells you if you put an equal weighting on all 500 stocks in the S&P 500, you're trading about where you were back in the end of July. So just speaks to the breadth indicators. And I wanted to, I might cover those because that's what I was going to do in yesterday's video. I started looking at my breadth indicators. I have some things to show you there. Okay, somewhat, in my opinion, very much related to the market. We're going to look at treasuries real quick. We'll start out with TLT. So right before the Fed, pre-Fed coming up, I gave you a setup if you wanted to fade it. Short treasuries, said on the 60-minute chart, we had a divergent high. We had this little wedge right here. That's where I gave it to you. And we broke down, triggered a sell signal. Like I often say, sometimes you break down, never look back, although there's always waves within a trend. And sometimes you break down, have a little kickback rally. And again, this was all this was the FOMC noise, what I call it, right at the FOMC meeting. Remember, the stock market dropped initially, and then that got faded and went the other way. Bonds did the opposite. Obviously, they went up. Bonds, this is bond prices, TLT, and then that was faded, and so we've effectively hit that target. Told you this would be your pullback target to that top of this recent trading range right there. And now, more importantly, so that call was right, whether you took it or not, but it was, for me, more, and it still is, watch the bond market. Let's see what's happening. As I said earlier in the video, one day doesn't make a trend. 2, 3, 4 days starts to make a trend, but just continue to monitor that trend. Again, this is the 30-year bond, the one that I'm watching. I watch the 10-year very closely as well, don't get me wrong. Did the same thing. So last year, as I talked about many, many times, the Fed lost control of the bond market. Was anticipated. We even went short treasuries, which means bet that yields would go up after, based on the chart. So it was a very nice setup. Again, this time around, I couldn't make as strong a case for this call I made last time, but that was the market certainly got the market's attention. And in fact, once, not right away, as I said, the masses often don't see what we see here in the charts. But the longer it comes on, just like the rising dollar, the fact the dollar's holding up, it's going to take that level that I told you to be taken out, my first target on UUP, move towards T2 before the masses realize it and they start selling gold and GDX. I told you until that happens, that's a very resilient trend. So right now the dollar's holding up, it's still holding above support, hasn't broken down, but it's not taken out my first target yet either. That already hit once, but needs to take it out now and go up to T2. Same with Treasury. So we were able to start to profit on on Treasuries. Betting yields will go up here, but this was that 50 basis point cut, and instead of long-term rates dropping like the Fed wanted to help everybody with their mortgages and all that, they went in the other direction. Then they followed up with another cut, as I mentioned, initial rise, a little abatement. Remember, nothing goes up forever. It was a wave, and then yields started rising again, leading up to that third and final cut. This is where the Fed said, "Ruh-roh, something's wrong here. We keep cutting, and Treasury bonds keep going up." There's not a person you or I know that gets to take their mortgage out based on the federal funds rate, the rate that the Fed cuts. Nobody gets to do that. Banks can borrow from each other or the Fed, discount window, federal funds rate, overnight lending rate. It kind of backfired. And again, we all know about it. It was well documented at the time. The bond vigilantes stepped up and said, you know what, you're going to risk inflation by cutting, so therefore longer term rates are going to go up, blah, blah, blah. So it didn't help. And then ultimately the stock market peaked here in October, and then it flattened out. Here, I'll show you just for those of you new to this. This was October right here. I'm sorry, December. The stock market peaked in December and stopped going up, started correcting, tried at those highs again, but never went any higher. And then that biggest drop in years came following, and that was, and remember, that started long before Trump even stepped up to the podium on liquidation day. Half the move, we were short already all the way down. Liquidation came after the market had already started correcting due to yields rising. So let's go back to TYX, because this is important in my opinion. So again, we'll watch it, but I just wanted to point out, it's been nothing but, this was a September 17th cut. Today, the yields, the 30-year yield for the first time, this is a daily chart, right now is ever so slightly red. Could still close green. Either way, and we're also, remember, I expect a reaction here. This is where TLT, I just started the video showing you the 30-year bond just hit that initial and sole pullback target I gave you. So again, to me, this is more of a watch to see what happens. Not today, tomorrow, next week. Again, I wouldn't be surprised to see the first red day here. Little pullback in yields based on bonds hitting or at close to support or consolidate. But in the coming weeks, if this continues up this way, it's going to be a repeat of what happened back then. And then I don't even know what Trump's going to say. He's clamoring, and he's got his minion on the Fed board now, clamoring for wanting 5 rate cuts this year. I think hopefully it'll become apparent to them that the market's not on board with that the bond market, again, the Fed can try as they may. They can get Treasury on board, issuing, the short end of the curve, trying to control the long end. But I promise you, the bond market is too big for the federal government and the Treasury to outright control. They can try and they can manipulate and use quantitative easing and other processes there, but at the end of the day, there's too many holders and potential buyers and sellers of Treasury bonds out there, and so if the Fed again loses control of the long end of the curve, that's going to impact where the market goes. Now, on the flip side, guys, I'm talking, hey, that's going to be bearish, especially if we break out to new. That would be multi-year, a breakout to multi-year and even multi-decade highs in yields. I can almost guarantee you the stock market will be freaking out at that time if that happens. Now, guys, it can go the other way. We just bounce back at the 200s. We go here. If it's a natural, organic abatement of yields and it's not due to a flight to safety bid, then that will support maybe that blow-off top scenario in the market. So again, watch. One of the most important things to me right now, Treasury bonds, especially in the wake of the Fed. I just want to say that it's starting out so far. Trump got the rate cut he wanted. The market got the rate cuts they wanted. And so far, this isn't helping mortgage holders, right? Or those, no, mortgage holders, I'm sorry, those looking to take out a new mortgage. And of course, that's tracked closer to the 10-year yield. We can look at TNX, but that's the same thing. There's the Fed rate cut, nothing but green, meaning every single day. Look, and we just tick green as I'm doing the video. So yields continue to rise on the 10-year. This is the one that the 30-year mortgage rates are most closely tied to, and that's that. So, all right, let's move on. The other thing I've been watching in the fixed income arena is the what I think has the potential to be the next shoe drop in the market, and that is the BIZD, which is the BDC, Business Development Company. These are private loans, private debt, private credit. They call it, sorry, private credit. And I started highlighting this here, saying a break of this level would be bearish, and give you some targets. We hit that first one, as is usually the case. That's support. Nice gap backfill. It bounced yesterday. It took that level out. It's now trading, back testing it from below. Watch this. It was in the headlines a few days. Remember, I've been talking about this for a few weeks, and just before, right in front of the Fed, they did start. I did Barron's or the Journal or Bloomberg. Somebody ran an article about it, but you know what? They didn't make. They spun it. My takeaway was nothing but bullish. That, oh yeah, these are going down maybe because it's their interest rates are going to go up, get cut, and so maybe some people are taking profits in there, and some of these things went ex-dividend. They didn't talk about any of the default risks on any of these loans, or what I talk about, this potential fictional pricing. The fact that just like private equity firms, and many of these a lot of private equity companies are involved in private credit as well, they get to just pick their value. They get a mark their market. Imagine you were a day trader, an aggressive stock trader, and you get to set your portfolio value, not your broker. So let's say you're in trouble, you're getting margin calls. Brokers will force you to sell to cover them, protect themselves, so you don't lose more money than you actually have with them. Because traders, when you're trading on margin, you're trading on leverage. You can trade up to leverage as much as you want with futures, options, 101 or more. And so it's and this happens all the time. It's part of the financial crisis. Institutions, when you're overly leveraged, you can lose a lot more money than you actually have. You can have $100,000 and end up losing $500,000 in the market. And guess what? The broker has to eat that if you don't come up with it. And so these guys are kind of the same way. And so, again, I don't know what leverage factor they're using and all that, but the point is, what I was saying is, imagine in the brokerage world, if you got to pick your value on your portfolio and say, no, everything's down today, but ignore that margin call, because I think it's worth a lot more. I don't think that stock that I held today that dropped 50% should have went down 50. So let's just call it a 10% drop. That's kind of what they do here, and until things start to get reset. And so if a lot of them have been overinflating or overstating the value of these the loans that they have, then all of a sudden, if you have one of these that starts to unwind positions and they sell, and now there's a price on a transaction, then everything else related loans, or even other companies might have a same stake in the same company, those values suddenly get reset, and they can go from being 99 cents on the dollar to 70 or 60 cents on the dollar overnight with a single transaction. So I just want to point out again, it's something to watch. And we took out that support yesterday. And a lot of these companies that I follow in here have also been going down. ARCC, top holding, that one broke support, looks almost the same, the chart. Again, a lot of these are trending in the wrong direction, which is, to me, a yellow flag, not a red flag, but a yellow flag right now. Again, looking for where the next shoe might drop. At KKR Capital, look at this one, FSK is a symbol. There's something wrong here. This is not, with the stock market all-time highs, why is this company just in free fall right now? And so again, and you might say, okay, well, that's their problem. It's not the rest. No, not always. A lot of times when one company in a sector implodes and there's an unwinding, they're forced to liquidate positions, and it can have a domino effect on the others. So again, something to watch, my friends, as I've been saying. And this, and then the other thing I continue to watch, credit spreads. They've held up tight. That's one reason what's supported new highs in the stock market. But I'm not the only one that thinks there's a huge mispricing right now, with very low credit spreads, meaning the risk premium or the additional rate that junk bonds are paying over treasuries, especially with the clear evidence we see of the job market turning. And that's all important. Of any single one indicator, there's not anything out there that has the predictive value of where the economy and the stock market's going, such as employment. And that's simply because consumer spending is 2/3 of GDP. And so the Fed's acknowledged the weakness in the turn in the job market. I've showed you many, many times without any variance for the last 60 plus years that once the job market unemployment bottoms at a record low and turns, it's typically a V bottom with an accelerating, and it doesn't mean over month to month. It's a turn that happens over about a year or so, but the trend has already started in the other direction. And so can continue to watch things, especially in the credit markets. That's where you'll usually start to see some cracks before the stock market breaks, because the stock market, especially if we're heading to a blow off top, and don't ever confuse fundamentals with the stock market. The stock market can disconnect for quite some time between fundamentals and reality. We saw that in the dot-com bubble. We saw it in the financial crisis, with banks and all those companies that were over leveraged and holding those dead loans, zombie loans that later on proved to be okay. Moving forward, just to catch up on some of the comments lately. Yesterday, somebody asked me about grains. I'm going to answer that. And then there was another one, I think, on natural gas and the VIX. I want to talk on that. And let's just dive in. So here's my reply on the grains. Corn broke down below the uptrend line off the recent lows today. So not great for that one, but still comfortably above. Here, let me just dive into the charts and you can read that. I'm not going to reread what's already written there. Save time and go read it. So the corn still looks good. Put in this divergent low. I put in divergent low here, hit my first target. Marginal new, still divergent low, hit it again. And as I said, we need to take, and I've been saying for many months now, unless we take that out, we need to take that out. And then so that's a potential powerful basing pattern. Still have positive divergence, still have it there on the daily. We have divergence here on the weekly. This one's not marked up fully, but I'm just going to mark this up. I'm going to move that PPO, get it out of the way here. You can see we just made a bullish PPO crossover on corn. So that previous low, this is a marginal new low, ever so slightly, with the divergence still very much in place, positive divergence. And you can see the primary downtrend line right there. So this right here, I think this coincides with my T1 level right here. So 1850-ish. And there's the downtrend line that will be taken out. And so, yeah, I still like these longer term. Let's extend that downtrend line. No, 1850-ish is right here. Yeah, okay. This level right here needs to go. And then, of course, T1. But I still like it. Soybeans as well. They're still, they're just, that's what these grains are doing. And it's a shame they don't pay a dividend. They'd be, I'd be, more comfortable and happy waiting, with a bigger position in these. But you got to wait till they break out of these basing patterns, and then they at some point should run. And then wheat, remember, wheat will typically follows corn, but it's been sucking wind a little more than that. I don't know if it's anything to do with what's going on over in, Ukraine, if they're flooding the market with wheat. I have no idea. I don't follow the fundamentals that close. I look at the technicals. You're welcome to. But we're still making that marginal new and still divergent low. But I want to show you. Okay, I've shared this chart dozens and dozens of times over the years, including quite a bit recently, but not in the last couple of weeks. So I'll just, if you're new to the site, this is the primary uptrend line on wheat. This is why, longer term they still look good. This is a multi-decade. That's 2000. Think of dot-com bubble right there, popping. This was wheat falling as the stock market was ripping to new highs with the biggest bubble we've seen in any of our lifetimes, if you were around back then. The NASDAQ went parabolic, followed by a nearly 80% correction. And that's exactly when the stock market peaked. And then, so once the stock market was out of favor, everyone started favoring commodities because the stock market was imploding. That was right then. And it started that secular bull trend right there in wheat. That again uptrend line, and we were buying it back here back in 2016 2017 on the site. There was a bullish falling wedge breakout. A lot of these were thrown out as trade ideas, and that's it. So I started getting bullish on the commodities. When we fell to that trend line here, we have positive divergence, and you don't get it often. So I've highlighted it here. You can go back on the site and you'll find a lot of these trade entries there. And big, 200, that was actually 217% from here to here. Yeah, that was a 200% run on wheat. This one from here to here was 380%. There was a bullish falling wedge breakout followed by a 110% run. So it still looks to me like it's coming. Now anything's possible. Maybe we break that trend line and go down. But over time, it only makes sense. Where inflation's now returned for the first time really since the 70s. And so ultimately I expect this to break out. So that's it. You just have to be patient. Don't put too much in. Wait till those levels break, that the next overhead levels, and then you can engage aggressively. And right now there's nothing wrong in my opinion with having a starter core position as part of asset allocation, diversification, but it's just, you're going to have to be patient with it. Like I said, unfortunately it doesn't pay a dividend, so it's kind of a dead money trade. But again, nothing's changed since back here. We're still on that, holding that nice trend line support with big positive divergences, just waiting for that right catalyst. That catalyst, again, it may be a fundamental catalyst in the news that you read about, but technically we need to break out this, probably take out this downtrend line right here. And again, corn and soybeans, watch closely because they all tend to move together, corn, wheat, and soybeans, give or take. And the other one is natural gas. Still like natural gas from a longer term perspective. This was a monster trade going long back in early 2024. Gave you some initial price targets, and as we're in that was a rare, what I call long-term trade, and gave you a target that was hit to the button, 490. And we were able to exit, reverse, turn around, short it. So we milked every bit of that 190% run, and actually more, because we had several times where we had on the 60-minute chart divergences to give you corrections and buy pullbacks to support re-enter. Now, back then, I had an arrow when we hit that at 490 right there when we exited that position for good. Had a potential pullback to this level, which we hit. And remember, most recently we went long there. So this is long-term support. And it reminds me a lot of, when we get these, the whole reason, case for going long that gas was these divergent lows right here. I love these weekly charts when we get these divergent lows, and then especially other reasons, support, bullish chart patterns, trend line breaks on the 60-minute charts, the daily charts. This is my weekly chart. This paints a big picture. So the big picture was and still is what I think is most likely of this divergent low. Remember, we also bought, you can't go wrong. You're buying natural gas down about $1, under $2 right there, $1.50. So it was a no-brainer entry, but this would telegraph the start of a new, bigger trend. This is the nature of natural gas. This 240%, 158%, 567%, 200% right there. So far only, quote unquote, with little air quotes, about 190. So this was the, initial target. And again, it was a get out kind of reverse 490. I didn't want to ride that out long, but this is still was, and it still is a potential longer term target I gave you way back here. And this is the uptrend line. Just like right here, if you look at these previous trends, you get pretty healthy corrections. and you want to buy pullbacks to the uptrend line right there. Here's one right here. Had a big, nice, healthy correction, and then boom, another leg up. So that's kind of the longer term outlook. And then near term, it's 60-minute charts. You know, told you to buy these pullbacks. This is it. We were most recently long here. We had the bullish falling wedge, the breakout. We took out R1. R2 has now been, as I did in the last update, we had 2 reactions there, so I raised that line a little bit. That's the magic number. We need to break that. However, where this is where the breakout occurred, so back to where this trade started, and that would be based on the long-term chart being at the trendline support. I can make a case there. Can't make a super strong case here other than the fact it's at trendline support. But there's a little minor trend line, so if it pops this, we head up, and then boom, if and we can break out of that 1345, those 2 recent highs, that should open the door to any or all these targets. And remember, much longer term, I just showed you the potential. Let me just flip back to it. If this starts to shape up, I'm just going to measure it for you to kind of give you an idea. Take this little tool here, click on where we're at now. And if you look all the way to the left, that says 127%. That's what, if we get up to that 6 to 640-ish level there, it's going to be anywhere from about 115 up to about 130%. Run in natural gas. And again, stops should be somewhat below that trend line if you're taking this as more of a longer term position. All right, we're almost done here. Back to that. So there's oh, and then corn. Yeah, I never did that for you guys. I was just on wheat. Corn, yeah, like I said, corn still looks fine. Divergent low, breakout of the wedge right here. Where is it? Come on, where are my drawing tools? There we go. Breakout. Oh yeah, I already covered that. We need to take out that T1 level in soybeans, I think. Didn't I cover that? Yeah, I did. Okay. Yeah, soybeans also just in this. Hit my first target, hit it again. You know, kind of longer term, we need to take out that recent trading range to hit these additional targets. All right, back to that. There was another question somebody asked. Okay, the VIX, absolutely. Yes, the VIX continues to set up in a bullish posture, holding support like a world champ, while continuing to make higher lows despite the broad market making higher highs. Pretty stark deterioration in market internals on this recent thrust to new highs. I'm even noticing a rare deterioration with the Mag 10, and especially, as I mentioned yesterday, NVIDIA and Apple doing all the lifting and the profit taken in the other ones. The VIX tends to run in fairly regular spurts, and if you eyeball the chart, it looks like it's due up for the next one. I was going to do a video today. Well, here I am doing the video now. That was yesterday's comment. Here's the VIX, guys. Here's the VIX making, again, this point here was a divergent low. We were long there, right, with impunity off the lows, milked almost all of that. We did it again here. We milked the 2 biggest runs. And what I'm talking about, when you look at the kind of the frequency, if you will. Let me go to a weekly chart here. And what you can do is take a trend line and you can kind of look at when did the VIX start to run. We had a period here, it started to run there, it started to run there. So there's a trend line. I'll make that nice and thick so you can see it. Here, we'll turn off all, well, no, I have to leave it on, I can't use it. So you can see it has these regular intervals. That was that previous low. I was doing this yesterday on the daily chart. I'm trying it here on the weekly chart. Intervals on the peaks were there. Yeah, there we go. A lot of these intervals line up. I wish I don't have on this one the time cycle lines. I have it on another charting platform that I don't have it queued up. But you can see these kind of almost like an EKG, if you will. Here, let me show you. Where you get these blurps that are on fairly regular intervals there. Again, you can see them over time right here. Big spikes up. It's kind of like again, like a bit of an irregular EKG, if you will. Either way, all I can tell you is this is what I've been saying now for the last few weeks. We have this uptrend line. We continue to hold support. It's price support as well right here. And the VIX, unlike the stock, you would think the VIX would be down here, right? Somewhere in here. And maybe it will. If we're going to have a blow off top in the market, the VIX will implode. It's going to take out that support. It's going to drop. You don't want to be a holder long term. You don't want to ride out a multi-week or multi-month blow off top in the stock market while being long the VIX, unless you want to use it as a hedging vehicle. Now, as I said the other day, last week, the RR looks good on the VIX. And again, we just have to kind of break out. This is the spot VIX here. We need to break out, I would say, probably above this 1720 level. But I can promise you this, guys. The VIX isn't going very far without the stock market breaking down. So I started the video showing you some sell signals. The market's still right where it was when I started today. So we haven't gone up. Those sell signals haven't been negated, but we haven't built on them either. So the VIX will wake up, and has the potential to explode. Again, that's what happens. Look at, divergent low, divergent low, divergent low. That was right there. That was the divergent low. And when it wakes up, it can move very fast. But it's going to take the stock market breaking down. That's what happened in each of these cases to do so. There was a case where it put in divergent low. You got the initial shot across the bow there, pull back, but it made a higher low. Another run up, and then that big drop there. That was at the end of that was April 6 lows, where again we covered all shorts, went long, and that's it. So we're just waiting for the markets to break down. If the stock market's going to have a blow off top, again, you can go back to the weekly chart of the VIX and see that, this is where volatility troughed back in 2018. But this is usually where, in recent decades, this is the low end of the VIX. And so far, it's showing you, it's pricing in something that the stock market might not be seeing right now. So, and as I've told you many times before, this is where bear markets end. When the VIX comes up here, shortly after that, the bottom's in bear markets. This is where corrections have ended since 2009 to 2025. And we had a couple shots there. We hit that level. So those are just corrections. So the next bear market, once it's underway, you're going to see probably much higher moves up in the VIX. So the potential is enormous. You got to have the timing right. And like I said, we have sell signals today. We had sell signals, right before the Fed. And then we back tested those trend lines that broke pre-Fed, as I showed you this morning, and then we just broke down the minor trend lines, but we're not really doing a whole lot right now. Zoom in, but we're still below them. So sell signal's a sell signal. Take it, leave it. It's up to you. Okay, the video went a little longer than I expected, but let me check my notepad. I believe I covered everything that I wanted to. Okay, those are the things to watch. And if we get anything big happens today, I'll do a follow-up video. So like I said, you can see the levels. There's a little minor, I'll just give it to you now, a little minor support here if you looking to buy pullbacks on QQQ or just want to have small short trades. But these are the near-term pullback targets. Every level listed here on the 60-minute chart. And a more comfortable drop would be down to this former T1 level, again, which we already hit back here. But to get back there again, that's going to be a drop now of about 7%. And if that happens, think back to the beginning of the video where I showed you the PPO histogram, what it looked like on a lot of the big stocks, as well as the Nasdaq. Nasdaq's in a little bit better shape than some, so same with the S&P 500. But it's those market leaders: Nvidia, Microsoft. Really, Nvidia, Microsoft already broke. Apple's number 3. Google's number 4. So Google and Apple are doing well, but Amazon, Nvidia, Microsoft, and Meta are all poised to make some bearish crossovers there, and as well as take out those uptrend lines. Again, Microsoft already did so. We just need the rest app do that. All right, guys, I'm going to wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great day.